Hi everyone, welcome to today's video. So on today's video, we are going to analyze the demolition of FMCG stocks. This is a very important video. If you're looking to invest in the FMCG sector, would now be the great time to do it? Or should you just sell everything and go away? That is the specific analysis that we are going to do. This will be a short but a very insightful video, but let me give out some very quick disclaimers. Point number one, I am investing in the FMCG sector. If you don't trust me, take a look at my holding of HUL. Now, the reason why I'm openly sharing this is fairly simple because I don't dole out hollow words. There are a lot of people who will do analysis, but they themselves in their personal life would not go and take positions in whatever they themselves are analyzing. So I do not do any of that thing. Yes, I can be incorrect like any other investor about the market. But whatever analysis that I'm presenting, I myself am following it. If you like it, please invest at your own behest. If you don't like it, please do not invest. But I'm going to explain you my rationale of why am I doing something or not doing something. Second, a lot of you ask me that, Akshat, how do you get to invest so much money in stocks, in different other asset classes? How do you do it? So the trick is fairly simple, that I keep a good track of my money. I'm frugal with my spending habits. I'm good with my investing habits. And I've been doing that for years. And that has allowed me to build a good corpus. To build these habits, you can check out Jupiter, who are the sponsors of this video. They allow you to track your money really well. They allow you to spend it wisely and invest it in a more systematic manner. So the links are in the description box. Do go and check it out. They promote something called as pot-spaced investing, which is linked to your goals. So do go and check it out, and let us start with today's video. So three specific things that I'm going to speak about. So one is that I'm going to give you an overall analysis of the FMCG sector from a technical standpoint. Second, we are going to speak about the pain points or the reasons for fall in the FMCG stocks. What are the primary reasons? And more importantly, should you be worried about those reasons? Third and finally, what you should be doing and what am I doing in this market? So we'll have a brief discussion around these points. But one very quick concept that I want to cover is the concept of mean reversal. Now, what is mean reversal? This is a very, very important concept for you to understand to make sense of what is happening with FMCG stocks. So mean reversal in simple word means that you would have seen a 200-day moving average line. I will show you on the chart of HUL also in a minute, but 200-day moving average line is considered to be the last 1 year average of the stock. So this will be, to an extent, is an indicator of mean, right? So this is generally what the stock price is. This is what this line simply indicates. Now what you will see is that the stock price, so I'm highlighting this in blue. So the stock price moves something like this, right? Sometimes it will follow 200-day moving average. It will come down, then it will climb back up. So this type of stuff keeps on happening. So the theory of mean reversal in simple words says this, that things that go up much higher than their 200-day moving average line, at some point they will return to their 200-day moving average line, and things that go way down their 200-day moving average line, they will come back up to their 200-day moving average line. This is a simplistic definition. Please don't quote me on this. I'm just explaining it from a conceptual level understanding. Now, why am I talking about mean reversal? The reason is fairly simple. Because right now, the FMCG stocks are badly beaten down. So let me take you to Hindustan Unilever, which is one of the foremost FMCG stock in India, and present this analysis. So here you will see this 200-day moving average line, right? So this is indicated here, right? So this black line is 200-day moving average. And this is currently the price. So essentially, the 200-day moving average indicates that the price should have been roughly 2430 and the stock is trading at roughly 2300. So there is a huge difference between these two things. Now, what does this mean and what is the implication this has for you? So the implication is fairly simple, that if you are an investor, then you just simply need to answer one simple thing, that is mean reversal going to happen in this industry or is it not going to happen in this industry? Has something fundamentally changed completely? If something fundamentally has changed completely, that, the FMCG margins have been brought down, or these companies are going through a very high debt situations, or these companies have lost their pricing power, then yes, you can make an argument that mean reversal is not going to happen. Has such a situation played out in the past? Yes, this situation played out in 2018, 2019 with housing finance companies when there was massive debt burden on entire industry. The entire industry collapsed and it has not been able to come up until now. So that was a systemic issue. So the only thing that you need to be worried about right now is that is the FMCG industry going through a similar type of a crisis or not? If not, this mean reversal will happen and all the FMCG stocks are going to go on an upward journey. Now let me also share very quick technicals around it so as to make my point even clearer. So you can see that this is the Nifty chart, and if you take a look at this chart, the Nifty from its recent high has been down by roughly 5.04%. So this is the current level of Nifty from its top, and it has been down by roughly 5% only. So what about FMCG Nifty? So if we take a look from the recent high, how much is it down by? So it is roughly down by 12.5%. So huge difference, right? There is 7.5% difference to be made. And if there is a run up in the Nifty, then FMCG stocks are likely to contribute more. So I hope this concept of mean reversal is clear. Now let's jump into the analysis as to why FMCG stocks are falling and should you be worried. I will break down all the specific reasons for you. So according to me, there are 4 specific reasons as to why FMCG stocks are going down. First and foremost relates to high inflation. So here is the data from the US. In the US, the inflation, and US is a stable economy. Even there, the rate of inflation is roughly 7%, which is very, very high. And that is causing panic in the market. Now comes the interesting question, because this is something that everyone tells you that high inflation, therefore FMCG prices are down, but they don't tell you this. And for this, I had to do a lot of digging. So similar situation happened in India in 2012-2013 when there was high inflation. And companies like HUL were able to successfully pass on the prices to consumers. This is the most important point, that if HUL back a decade ago in 2012 was able to do it, why can't they do it now? Here is the article to prove it. You can zoom it out and I will read this with you. Even in 2012 to 2013, this kind of scenario, high inflation scenario, where inflation was extremely high, companies like HUL and other leading FMCG companies managed to pass on the input cost. So input cost simply means that HUL, if it is making a soap, then the supplier demands more compensation because everything has gone up in price. So HUL pays them. Now they pick up these prices and inflate the prices for consumers like us. And we still end up buying those products. So HUL does not become a sufferer under such circumstances. Now the second key thing is around sector rotation. Now if you want me to make a separate video on sector rotation, I will make it. But just to cut the long story short, this ties into the mean reversal concept that I was telling you, that right now, if you check the FMCG sector, it is down by roughly 12%. If you check Nifty 50, it is down by roughly 5%. Similarly, if you check banks, they will be roughly down by 10% from their top. So if you make an argument that Nifty has to go up from 17,700 to 20,000, then which sector do you think is going to contribute more? Of course, these will be sectors like FMCG and banks. Why? Because of the fact that these sectors have not given run up as of now. When they start giving run up, you will have a very hard time chasing these stocks because they will go up by 3-4% in a day. If you don't believe me, just check the performance of HUL today itself, and I'm putting the chart here. It gave an up run of 3%. Now the third reason for the fall is shrinking rural demand. This is a very interesting macro concept to understand. Now the way rural demand functions is like this. And you need to understand the entire landscape. What happens in villages is that the majority of the economy is unorganized economy. What do I mean by that? For example, if you are working with TCS, Infosys, McKinsey, BCG, you are educated. If you go and tell your employer that, hey employer, the inflation is high, please increase my salary, they are likely to do it. Why? Because you are educated and your employer is also educated. So they understand this basic game. Now I'm not saying that they will 100% increase your salary, but at least that's the understanding that next year, probably we'll have to increase people's salary because the inflation in the economy is high. Now, this situation does not work out in the unorganized sector. For example, when there is a local labor or a farmer, if he or she tries to sell their product, or if they say that Malik, please increase my salary by 15 rupees or 20 rupees per day, they are not going to do it. The Malik will simply say that, no, you know what, the entire economy is very expensive. My expenses have also gone up. So I am not going to increase your salary. Just do whatever. That's a major problem. And that is precisely the reason why poor people in India suffer the most. Now, how does this impact FMCG companies? What ends up happening is that if there is shrinkage of economy in the rural sector, people A would not have the money to buy stuff immediately because they do not have any disposable income, so to say. And second and more importantly is that everything to them would look very pricey. For example, you might have read that HUL increased its product prices by 15-20%. Now imagine this, that if you are a local farmer who goes and buys soap from a local shop, you will say that, okay, last week the price of this soap was 10 rupees. Now you are selling it to me at 12 rupees. So my price has gone up. I can't afford to buy this. Yes, and this is a very valid concern and we should be scared. But what is the tool that these big FMCG companies deploy? That's the very interesting part. So this is what they do. And I hope the picture itself explains you the concept of shrinkflation. So shrinkflation simply means that instead of increasing product prices, they decrease the quantity of the product that is being sold. And a lot of people might not even be able to understand this or process this, and they will eventually end up buying this stuff. So these type of tricks are always deployed by big FMCG company. I'm not supporting that move, but this is the reality. But the point that I want to drive home through this conversation is that, see, the rural demand in the short term will shrink a little bit, but it's not as if that it will permanently disappear. As the situation starts to improve a little bit, as the inflation number goes down a little bit, all these buying habits will return, and it will hardly take a couple of quarters. Now comes fourth and final point, and I have seen a lot of people commenting on social media that the reason why FMCG stocks like HUL, Nestle, Marico is falling is very simple, that a lot of local competition has come into the picture. In fact, this understanding is incorrect. Why am I saying this? Because you need to think about this situation from a profit margin viewpoint. Now, inflation has risen for everyone. It's not as if that inflation has only risen for Hindustan Unilever and not local players. What happens is that these big players like HUL, Dabur, Marico, what they do is that they procure things in bulk. So they still have something called as bargaining power, because if HUL is buying, let's say, 1000 kilo of tomatoes to make tomato sauce. Now, if they are buying 1000 kilo of tomatoes, that's a huge quantity, and therefore they will have some bargaining power. But if a local tomato sauce manufacturer is trying to do the same, they will probably buy 20 kilos of tomato. So this supply side inflation is going to hurt these local players more compared to these big giants. They still have pricing power. They still have branding power. They still have tools like shrinkflation at play. So they are going to deploy every tactic in the book to keep their profit margins intact. Now, how can I demonstrate this point from a quantitative viewpoint? Can I show you some numbers to prove this fact? Yes. So let us go to HUL's balance sheet. So here is what you will see as revenues, right? So let's compare 2016 number. So 2016, the sales were at 32,000 crores and the profit was 4,151 crores. Now let's take a look at 2021. The profits have 2x. So profits have become 2x. Have the sales even doubled? The answer is no. They have been less than doubled. So what does this show? This shows that the profit margins of these big companies is very much intact. And in fact, it goes up because of high inflation environment. So this is a very important point. And let me also depict how does this translate to a better stock price. So if you check the stock prices of HUL in 2019, so it was roughly trading between 1815 to 2000 to 2100, right? So 2019 we are talking about. Now, what were the sales number in 2019? It was roughly 40,000. What were the profits? The profit were 6,800. Now the profits have gone up by how much? So they have gone up by roughly 28%. If you take a difference between these numbers, 2019 6,054 and roughly 8,000. So that's a roughly 25 to 30% increase in profits. So this should translate in the increase of stock price also. So from that particular simple analysis, the correct rough approximation of stock price for HUL comes out to be 2,500, which is closer to its mean reversal where I started the story from. So I hope this analysis is clear. Now the final verdict. What is the summary? Should you be buying it? Should you not be buying it? Now I'm buying it. I can be wrong, but this is what the data tells me, that the mean reversal in FMCG should happen. When will it happen? I don't know. Maybe 2 months. 6 months, 1 year, 2 years, but long-term prospects have not changed for this industry. There is nothing off about this industry. In the short term, no one can predict the stock prices, but this, according to me, is a great buying opportunity. I hope you enjoyed the video. Do check the links in the description box for Jupiter. It's a wonderful app. It would allow you to track your money better, save your money better, and invest your money better. Please like the video and I will see you tomorrow.